Hi and good morning everyone, and welcome to our webinar. I'm Mona Johansen and I'm the Marketing and Communication Manager for Coface Nordics, and I'll be your host for today's session. I'm joined by our experts, Jonathan Stenberg, our economist, and Pekka Putanen, the CEO of Coface Nordics. And they will unpack the latest insights from Coface Risk Review, the calm during the storm, and what it means for Nordic businesses. Before I hand over to our speakers, a few practical notes. The duration of the webinar is about 1 hour. We'll have a Q&A at the end, and you can submit your questions at any time during the webinar. And you can do so by clicking on that little question mark on the top of your screen and type in your questions. And we will collect them as we go and answer them at the end of the session. The webinar is recorded, and both the recording and the presentation will be shared with you afterwards. So with that said, let's get started, and Pekka, the floor is yours.
Thank you, Mona, and welcome everyone also from our side. We have a very interesting, exciting set of content today. I think an ample amount of events have taken place between today and our previous economic webinar. One of the biggest drivers obviously has been the Liberation Day in early April that really did throw relatively large challenge to the global trade. I think all in all, we went back to the 1930s when it comes to friction to global trade without barriers. So the tariff play has been a gigantic driver. But at the same time, the last quarter of the year is always exciting because there's a lot of interaction with our clients, with the C-level of our clients in order to understand how 26 is looking, what are the anticipations. And surprisingly so, or maybe not so surprisingly, in fact, it's extremely difficult to be super bullish about the future. We are seeing continuous flow of geopolitical topics rising. The political, let's say, intensity is increasing. If we are looking simple key metrics such as global trade uncertainty index, we're seeing all-time high levels, double the values of what it was when we were hitting the peak unpredictability in COVID. And it's very unclear how the world will in fact look like. So we are kind of entering to a world of extremes where we are still driving with increasing level of indebtedness. So we are gaining more on debt side, and we are not able as a globe to generate a sufficient level of GDP growth in the backbone of that debt coming into the economies. And what has been a big driver of let's say, growth in generally speaking has been built based on a free trade agreements between nations, blocks. Now, these blocks are becoming less clear. We see US taking its own direction. We see China really answering to the challenge of US. We have Russia doing their agenda with their allies. We have Europe somehow in between, trying to understand how they can play. So it is really difficult to find a lot of positive signs for going forward. But again, there is always ample of opportunities. And companies operating in the Nordics are actually sitting in a fairly good place, given all the context that I just laid out. So there is a lot for us to also gain in these times. And one of the big drivers of expectations of forward-looking growth is also coming from something like AI. We are witnessing an extreme investment cycle to AI-linked activities. And this is something that Nordics has its own role to play, for sure. It's not only limited to that, of course. But all in all, we're living in a very volatile environment where risk mitigation, creating buffers, companies to be really focused on maximizing their liquidity or at least access to liquidity for just in case events. It's very, very healthy to think that the frequency of crisis that has increased significantly during the last 10 years versus the previous 20 years is here to stay. So getting prepared, mitigating your risks, understanding the working environment of your business, how different external factors might impact that, are all critical topics that our clients are discussing in their management teams. And on that context, I think the COFA's risk review actually gives quite a lot of good insights on this. And without any further ado, I would like to hand over the mic to Jonathan, because there's a lot of good content. So please, if you come up with any questions, we'll take them after the panel and have a good Q&A session when we get there. But Jonathan, over to you now.
Thank you so much, Pekka. I think you covered the main bits of what I'm going to cover today, so we can almost stop now and move over. But I'll still try to sort of elaborate a bit on all the key points that you've just highlighted. We've called this webinar the calm during the storm, and if you've seen our risk review, there's this very nice image of a storm in which right in the middle of it there is actually a bit of a vacuum. And to a certain degree, I think after a very, very turbulent summer right now feels a bit more quiet to a certain degree, which has been nice. But we're still to a large degree waiting for some of the first and second order effect of this massive shift in global trading relationships that we saw during the summer actually to materialize. So that is, the overall narrative as we go into this presentation. I want to show our global risk assessment map to start with. Hopefully you've seen it before. If you haven't, this is our way of doing country risk assessments, which unlike Moody and S&P isn't focused on a sovereign's ability to honor their debt obligations. If you've seen something like that, you'd know that more or less most of the Nordics will be in a AAA rating. Everything is fine. The sovereigns can always honor their debt obligations. But what we're focused on more is the underlying business environment. How is the business environment from a non-payment point of view? Because that, as credit insurers, is what we really care about. And that's why you probably will see a bit more granularity here, in which, for example, you'll see Norway, Denmark, Switzerland, Luxembourg being A1s, whereas someone like Sweden, Finland are still an A3. At the moment, and you can see this slightly more higher level of granularity across Europe, but also North America. We did an update in October, which is one we're talking about now, and we did do a few larger changes. The most significant one is probably a downgrade in Canada. It is related, obviously, to the trading relationship with its main trading partner, the United States. But to be completely frank, the Canadian economy was already showing some signs of weakness, and obviously a deteriorating trading relationship with its most important trading partner. It's just that additional blow that meant that we felt that we probably were looking at more of an A3 country at this point than an A2. As you know, some of the underlying domestic activity was also slower than it had been. We also have seen some upgrades, maybe surprising when you read the overall news, but we are still relatively optimistic on somewhere like Vietnam, which we think really still can benefit from a friendshoring, China plus one policy, etc., etc. And we continue to see actually pretty decent investment going into Vietnam, strong export figures, including re-exports, and compared to some of its peers, it actually ended up receiving a relatively benign level of tariff rates compared to some of the other peers in Southeast Asia. We saw two upgrades in the Middle East, that is Saudi Arabia and the UAE, and that is continued relatively strong economies which are relying less and less on oil as a primary driver. Actually, for them at this point, around 70% of the GDP is non-oil related. And they continue to invest a lot in these non-oil sectors. And to be completely frank, they are seeing still a relatively strong and healthy economic growth and decent business environment. The last one is bringing the Czech Republic back into an A3, which really, to be fair, is more of a slow and gradual economic improvement that we've seen over the last year, where it probably is now closer to its steady state level after really struggling along with some of the Eastern European countries with quite high inflation and timid domestic demand. At the same time, its manufacturing sector is slightly healthier than many of its neighbors, and on top of that, its government has a lot of a healthier budget and debt level, which means that if push comes to shove, there will be an ability to support companies, and that was sort of why we felt comfortable enough bringing it to an A3, which in Central and Eastern Europe is a higher rating at the moment. So to go to some of the more thematic points, Pekka already mentioned a Liberation Day, the emergence of tariffs, and as you can see, I think one of the things we want to highlight is that Trump doesn't always chicken out. Again, during the relatively turbulent summer, there was this taco trade that you could always count on Trump to eventually chicken out. And what we want to highlight is the fact that when it comes to tariffs, he means it. It is something that he's quite serious about. It's something that he has been consistently serious about, and been relatively consistent and honest about what his opinion is throughout his current presidency, but also his previous one. And to be honest, in the last few decades, he is protectionist by nature. He supports tariffs, although they are not as popular. Parts of them are, while people don't like the higher prices, they do fundamentally like the idea of someone else paying for this trade deficit. So while some of the impacts aren't, the tariffs are still something that I do think he fundamentally believes in. And again, as you can see, we are now starting to see this impact the economy. The average import tariff rate on duties have gone from about 2.5% to currently about 10%. The last figure here was from August. We've had a bit of a slowdown in recent figures due to the shutdown in the US, but we basically expect this to be a bit more than halfway through what we believe will be the terminal rate for the time being, which will probably be between 15 to 17% once you have the full implementation of the current agreements. And as you can see on the right hand side, this differs slightly from country to country. We've seen significant increase in China, but to be honest, it is across most trading partners. What sometimes surprises people on the right-hand side, you see Mexico and Canada, which on the face of it have very, very high tariffs, but because most USMCA goods are exempt from this, the actual tariff rate in both Mexico and Canada is not expected to increase that much more, to be completely honest, because most of the trade within that block is under the USMCA compliant. So the bigger question there is when that needs to be renegotiated, what will happen to rates then? A question that I'm sure some people have, and I'll try to answer relatively quickly, is what will happen with the Supreme Court's decision? Is that something we believe they might consider the current IEEPA tariffs illegal? And what would happen subsequently? Essentially, we do think they will probably say that in their current form they are illegal. Something to keep in mind is that the Supreme Court works slightly different from other courts in the fact that they can say, for example, they're illegal in this way, but if you change this, it wouldn't be illegal, or if you limit it to these countries, it might not be illegal. The Supreme Court has the authority to make that sort of more distinction as opposed to just a black and white, legal or illegal. And we also want to highlight, even if they went out and said blanketly, you can't do this, it's completely legal, we don't give you any caveats, that the Trump administration have a lot of other levers they can use. For example, all these sectorial tariffs that we've heard a lot on, metals, automotive, pharmaceuticals, chemicals, lumber, all these ones are actually legal. These are Section 232 and are completely legal. These are not the ones being disputed. And also, the administration have a lot of alternatives they can use in this case. So what we want to say is, even if it is deemed illegal, our expectation is that the the goal of the administration will be to maintain tariffs at a relatively high level, and they will try to push this as far as they can, which means the ostrich approach, which is get your head as far down on the ground as you can and hope this will all be over when your head comes up. We don't think really is a sustainable strategy, sadly, even though it does seem very appealing for the time being. A second question we've been asked a lot is who's really bearing these costs for the time being? And really the very boring answer it depends on your sector. So we have had sectors in which we are seeing, for the majority of the cases, it is actually the exporters bearing the cost for the time being. A very clear case of this is beverages, alcoholic beverages in particular, in which we are seeing that most exporters to the US are cutting their prices in order to maintain market share, whether that is whiskey or wine or cognac or snaps. There is currently a lot of companies that are, for the time being, cutting their prices in order to maintain their market share. However, what we also know is that most of them are saying this is gradual. They are planning to eventually increase their prices in order to regain their margins. But we are seeing, for the time being, actually some of these exporters and some of these sectors are seeing shrinking margins, which is something we're obviously acutely aware of when we look at the credit risk. Other sectors, however, such as audio equipment, you can see on the right-hand side, there's been no impact on exporters. They maintain their margins, and most of this is being pushed on either onto consumers in the majority of cases, and in some cases, US intermediaries, companies, wholesalers, etc., are eating some of this increase in costs. Basically, I think you can say on average, B2B seems to be slightly less volatile in the fact that companies are usually better at finding alternatives, whereas consumers usually, we like something so we keep buying it. And the second and probably most important one is there a more or less 100% American alternative? With audio equipment, there isn't many. With beverages, there is American alternatives to a lot of it, which means that you actually do have an alternative which is untariffed. And in that way, in order to not see an increase in your prices, you kind of have to, on the short and medium term, probably to cut your prices in order to stay competitive. So that is sort of the general of who's paying these costs. We've generalized this a bit. If there's any specific sectors people are interested in, we have done this on a sort of more gradual scale as well. But if you look again at somewhere like electronics, most of this is being passed on to consumers. The consumer prices have increased. What's interesting is actually in this case, we've seen a bigger increase in prices than we necessarily can say that it would warrant from a tariff increase perspective. Is essentially there are some retailers who are seemingly saying, well, people know prices are going to go up, so I'm going to increase them a bit more to maintain a margin, even more so than my costs are actually increasing, because people are aware of the fact prices will probably increase. In somewhere like automotive, we're seeing a bit more of a divergent picture. We know that some exporters, particularly Japanese ones, have been very honest. They're planning to cut their prices relatively consistently. We're seeing people with existing stock, such as car dealership, that already preloaded a lot of this, already had the stock in the US, increasing their prices even though they bought it at pre-tariff levels. But we are seeing some manufacturers who are feeling the brunt of this, especially when it comes to some of these parts. It's a somewhat similar story when it comes to metals. If you are a US upstream manufacturer, so you produce the metal, you might see a slight US premium for the time being. Anyone downstream, that's metal manufacturers, automotive, aerospace, etc., are seeing these increases in costs. And for the time being, we are seeing some exporters cutting their prices as well in order to stay competitive. I've already gone through beverages, and again, as you can see on the right-hand side, when it comes to textiles and furniture, we are seeing some exporters cut prices, particularly in the latter one. But really, for the time being, consumers are feeling the impact. They're buying less, and some of these retailers are also seeing a drop in demand as uncertainty has started to impact consumer sentiment slightly in some of these sectors. To sort of continue on a more thematic point here, this is going to have a massive impact, not just directly, but also indirectly. And the relationship between China and Europe has really changed fundamentally in the last few years. And what we know and what we can see is that when the US becomes less attractive, Chinese exporters will try to focus on other blocks. We can see this on aggregate. I can also tell that I had a meeting with some Chinese CEOs a few months ago and asked them sort of if the US could kind of maintain the current level of tariffs, what do you guys expect to do? And almost unanimously, they all said, well, we try to focus on other export markets. We don't have the biggest confidence in our domestic economy, so we'll probably look at elsewhere, and Europe is an attractive place because there still is a lot of purchasing power. And you can really see this in the competitiveness of a lot of Chinese companies compared to European ones, particularly within manufacturing, is really difficult. It is very expensive at the moment to produce anything in Europe. We both have high labor costs. We also have seen this massive increase in energy prices that should abate somewhat, but this does mean that the competitiveness of European manufacturing just has fallen fundamentally compared to other regions, and China in particular is a good case for this. And that sort of very nicely brings me over to European manufacturing as a whole, in which, on a turnover basis, we did see a very strong recovery in 2022. However, most of this was really down to higher prices as opposed to big increases in volumes. As you can see, if you look at a volume level, we are slightly above the 2019 levels, but not really by much. And most of the increase we have seen is really down to increase in turnovers and increase in prices. This is across many countries, but as you can see, sort of some of the more significantly impacted one is Italy and Germany, to a certain degree also the Netherlands, with particularly Italy and Germany being very sensitive to slowdown in the automotive sector and having quite high energy costs as they depended more on Russian natural gas than many other European economies. They were particularly sensitive to the shock we've seen in the last 5 years from a manufacturing point of view. And again, when looking at sort of by sector, where are the biggest slowdowns? It's to a large degree in these energy intensive ones. As you can see, your metals, your chemicals, your machinery to a certain degree have really fallen behind, as it's just less competitive. There's been less demand. And then automotive is obviously a clear one in which the automotive sector is just not what it was, and probably, to be completely frank, was struggling a bit with oversupply even before the pandemic, and that has now really become clear. Again, there are some signs of improvements. Agri-food continues to stand out a bit as a slightly stronger manufacturing sector. Electronic equipment is doing a bit better, and we are seeing some positive signs in machinery, especially in sort of the high end, where we in Europe are slightly stronger. But again, sort of these other sectors, especially some of the more energy intensive ones, we continue to struggle and just be less competitive than many of our peers. So do we fundamentally believe global world trade is over, or that it has really changed? No, we don't believe it's over. We do believe it's changed. As you can see, after sort of quite rapid growth until the mid-2000s, until basically the global financial crisis, we saw very rapid growth and has since then seen more or less a stabilization of it. What is quite clear is that we are seeing this difference in who trades with who to a larger degree. And I try to show that on the right-hand side in this geo-economic fragmentation. So initially it was all about offshoring. It was just about making things as efficient as possible. COVID happened, and suddenly it was more about resilience. It was reshoring, it was nearshoring. It was really focused on this idea of, okay, it's not just about efficiency, it's also about resilience. Then we had a war in Ukraine. geopolitical tensions increase, we start realizing, okay, we can't necessarily rely on everyone. We want to not just reshore, we want to friendshore. So it's not just the closest country, it's also the closest country that we are friends with. Again, also diversifying a bit. I mentioned Vietnam earlier, and that's a classic China plus one policy. If you're a manufacturer, you think maybe we're slightly over-reliant on China, we won't necessarily completely exit it, but we will look at other alternatives as well to make ourselves more resilient. But also, if there is an increase in geopolitical tensions with China, we do have an alternative base in which we can focus more on our manufacturing. And yeah, obviously the latest trade war is just a further acceleration of this latter trend towards really focusing more on not just actual resilience, but also geopolitical resilience as well. So what does that mean for our actual economic expectations? Well, generally speaking, on a global level, we expect growth to decelerate down to 2.6%. This is, as you can see, quite a low growth year when it comes to global growth, the lowest we've seen in quite a long time. If you exclude 2020 and even if you exclude 2009, we need to go back to the start 2000s before we've seen this sort of low growth year in a non-crisis year. And we actually expect this to further decelerate in the coming year. The positive sign is that the majority of this is coming from a slowdown in the US, as well as a continued slowdown in China, whereas our expectations for emerging economies without China is roughly unchanged. And as you can see, actually advanced economies outside of the US is slightly down, but actually more or less unchanged as well. So most of this global slowdown comes down to US and China. And really, this is US coming from a very, very high level to now a level that is still very strong. To be completely honest, we expect again 1.8, 1.7 in 25 and 26, which is still relatively strong growth, but obviously a clear slowdown from this sort of extraordinary growth that the US saw after the pandemic. Closer to home, we do expect, I'd say, lackluster growth at best in most of our trading partners, so Japan, UK, Germany, France, Italy. Most of these countries, we do expect growth to be between 0.5% to 1% also in the coming year. So again, there's quite like stagnating growth, to be completely honest. China, we expect a continued slowdown, whereas in India, we've actually upward revised our forecast slightly, as India has done what China has been trying to, which is really focus more on domestic demand in the last year. So really trying to focus their policies on improving here, and to a certain degree, we do believe that is relatively successful. For the Nordics, we do expect relatively strong growth in the coming year. Some of this will be down to base effects. That is, for example, to a large degree the case in Finland. The Finnish growth momentum is still relatively weak, but there are some signs of improvements, or at the very least a bottoming out. And so a lot of what will help the growth next year is what we like to call base effects. Basically, coming from a low enough level means that you have some carryover that will support a higher overall GDP growth, even if the underlying momentum isn't that strong. In Denmark, we expect a relatively lower growth level, as we've seen a slowdown in, among other things, the pharmaceutical sector. But to be completely honest, the labor market is still relatively stable. Real wages are still picking up, which means that we still expect that to be a relatively fine momentum there. And in Norway, we expect again a relatively benign environment as well, and a bit of recovery in Sweden. But I'll get to that in a second when I sort of deep dive a bit more into the Nordics. For global insolvencies, it's obviously still that we saw the return to normality in 2023, early 2024, continued increases in insolvencies in 2024, and that is overall still true for the time being. Insolvencies are particularly picking up in Asia and Europe, and actually, as we just got the Q3 figures for the US, it is now luckily, as we expected, picking up as well in Q3, which is not just an impact of the trade war. We do believe there'll be a bit of lag when this really comes, but really a sign of a slowing economy in the US in particular. That means we are now seeing a higher level of insolvencies. But again, as you probably will note, North America here, with the US really being a big weight here, is a lot lower than its peers, both in Asia Pacific and in Europe, in looking at where corporate insolvencies are for the time being. So if we focus sort of closer to home, where are we on an inflation level? Well, basically in most countries, inflation is under control. There is one exception here, which is that it continues to be slightly, not slightly, it continues to be too high in Norway, to be completely honest. And that will be a somewhat restraint on the central bank. I'll get to that in a second. But if we focus on the other ones first, well, we are seeing a relatively benign environment in Denmark with the change in electricity subsidies, electricity taxes in particular. We do believe that inflation will be pulled down. And again, in both Finland and to a lesser degree in Sweden, as there are still some inflationary pressures, but in Finland in particular, we don't really see inflation to be a massive issue. And again, the latest figures were actually showing deflation in Finland, although some of these base effects should support that we won't continue to see this next year. So what does that mean from a central bank and a policy rate point of view? Well, essentially our main scenario is that the ECB is around its terminal rate unless we see a complete slowdown in Europe. We do believe they're quite comfortable at the current levels. We believe that the Danish central bank, Nationalbanken, will obviously follow this. For the time being, we also believe that the Riksbanken will. Again, we do believe there is a bit of a potential improvement in the Swedish economy. If that coincides with a bit of increase in inflationary pressures, there is a chance that potentially there could be an increase in the future. But again, our main scenario for the next 12 months is probably most likely an unchanged one as well. And then lastly, obviously, we have Norway and Norgesbanken, and given the fact that there are some issues around high inflation, given the fact that the economy, while it's slowing down, is not collapsing at all, we do think the Norgesbanken's mandate is more limited in regards to cutting, although we do believe there will be 1 to 2 cuts in the next 12-month period, although they are restrictive. And I will say, well, it's boring as a forecast to say this, they will be very data dependent here, and they'll really be looking at what are we seeing from an inflation, from a labor market point of view, and from an economic growth point of view. I don't think there is a 100% certain path here. For the US, we do fundamentally believe that there will be interest rates cuts going forward, given the fact that while there are some increases in goods inflation, in parts due to tariffs, the labor market is still pretty cool. Wage growth is easing, and the US is a service economy. As long as service inflation isn't significantly picking up, you won't see a massive resurgence of inflation, which means that we do believe the Fed will be able to continue to do sort of a gradual cutting cycle next year. So focus more again on the Nordics here. A big question will be, where will the demand come from? Again, we had these relatively positive growth forecasts. And to a large degree, to be honest, in Denmark, in Norway, in Sweden, we are seeing relatively generous budgets, which means the government spending will continue to support growth. That's quite a positive story. Yes, a lot of this is going into somewhere like defense, but it's also going into other sectors as well, and having a positive dividend on the economy. We do believe there is still some momentum in exports, even if we do believe this will be a slower growth than the last few years, as we basically are seeing global trade slowing down. And again, as I said, the global growth to be weaker than it has been. So while we do believe there is some growth momentum in exports, even if we do expect it to slow. Lastly, then we're focusing on the private domestic demand. And in here, we are seeing clear improvements in Denmark, in Norway and in Sweden. And again, as you can hear, the exception here is to a certain degree Finland, and you can see that on the left. On the left-hand side, in which we have seen improvements in consumer and business investments, in private business investments. In the remaining countries, it has been coming up from sort of its lowest level in late 2023, early 2024. Whereas in Finland, we continue to be relatively weak growth here. Which will take a while to sort of recalibrate and generate a positive momentum in the private economy. The government is doing the best, and some of their policies should spur some of this. But really, it's proper recalibration that takes a while to really significantly have an impact on the economy. So the domestic demand there in Finland is to a certain degree not as positive as the remaining Nordics. So looking at some of the key markets, sort of if the US is difficult, if China is a difficult market as well, where do we believe some of this growth will be coming from? Well, the key other export markets for the Nordics are, I don't think surprisingly, it's very close to just being our neighbors. To be completely honest, it's Germany. It's a clear number one, but it's also Poland, it's the Netherlands, it's UK and France. So where is our growth expectations here? Well, so in Germany we expect relatively slow growth. Some of the fundamental weakness of the German economy we still expect to be there in 2026. Now that includes a weak property sector. It came from a very strong momentum pre-pandemic, but we continue to see higher non-performing loans, higher insolvencies in this sector, and not the strongest momentum there. And again, Germany was really struggling in its manufacturing sector even before the pandemic and increase in energy costs. So overall, energy-intensive manufacturing in Germany continues to be a struggle, even if we do believe some of the government's policies will support it slightly. We do still think it will take a while before we start seeing a proper improvement within here. But there are potentials in Germany as well. We're seeing a lot of public investment. Some of it slightly slower, and we also want to. There's a reason why we have a relatively low forecast for Germany, is that it takes a while before this to actually start having an impact. But there is a lot of investment going into civil engineering, defense, and ICT in particular. Although we do want to highlight the fact that, particularly in the first two of these sectors, they are really almost at capacity. Which means sort of in a worst case scenario, this will mainly just end up resulting in higher prices as opposed to increased demand. But again, it's sectors in which there will be a lot of capital going into it, and there is a proper demand side momentum, although maybe supply has a bit of a hard time following suit here. In the Netherlands, it's obviously economy very, very sensitive to global trade. It moves with the world, to be completely honest. But sort of the underlying economic situation in the Netherlands is okay. Domestic demand is relatively stable. The government has been relatively I was about to say inefficient in the last few years, and they currently don't have one. But there is still a possibility to do some once they figure out who should lead the country. And the Netherlands does have some strong sectors as well. Its construction sector is stronger than many other places in Europe. They have a very strong semiconductor sector, not just ASML. They have some other really good actors there as well, and we are seeing a lot of strong momentum coming out of the Netherlands there. So there's a bit more of a positive story there. The UK is a bit more of a mixed bag. Weak private sector demand still, although increasing. There has been a lot of policy uncertainty, which hasn't helped private business investment as much as hoped. But there is still some positive signs here. Again, I might be repeating a few things here, but somewhere like the defense sector in the UK is really strong. It's still really strong in pharmaceuticals, and there is money going into infrastructure, and they are seeing quite a big change in regulations around planning and infrastructure, which should gradually start supporting some activity in this sector. So there are opportunities there as well. In Poland, which is I think maybe a slightly more bullish case for growth potential, we expect growth to be above 3% in 2026. We still are seeing some weakness in its manufacturing sector. That's a combination again of being relatively energy intensive and being very reliant on German demand. So there's a lot of manufacturing in Poland that it essentially feeds into to German manufacturing, which obviously means if German manufacturing is not doing well, then that has a second order effect on the Polish economy and their manufacturing sector. So there is some weakness there, but on the positive side, inflation has come down. Domestic demand is really increasing. The labor market is more stable, and they have actually seen a relatively strong service sector as well in Poland, stepping up when their manufacturing sector has been slightly weaker. And there still is a lot of momentum somewhere like construction, even if it is still a risky sector in the country. Lastly is France. Some of the weaker growth, as you can see, France still has just a slow economic development. To be completely honest, nothing is really collapsing. We are seeing a weakening labor market. Domestic demand is increasing slightly, not falling apart, but not really growing by that much. They have some very strong sectors. The service sector continues to be very, very strong, more or less across the board. It's not just hospitality or tourism. They have very strong ICT sector. They're really good in professional services, and on the manufacturing level, they're really good in aerospace and defense. So they have some really strong sectors, but obviously they are struggling with a lot of political uncertainty, which I think even our colleagues in France will accept, which means they are limited, and again that will have a big impact as public spending has been a key driver of growth in the French economy in the last few years, and given the fact they have to limit that, there will be a slower momentum here, and potentially that can have some negative second order impact on overall demand. So what are we actually seeing for insolvencies in the Nordics? Well, the story is still that for Denmark and Norway, we are looking at roughly levels akin to what they were in 2019. So again, the last normal year we believe we had, and they keep on being relatively just moving around this level. Not very, very low, not very, very high, just at this sort of stable level. They have been very, very elevated, and to a certain degree still are quite elevated in both Finland and Sweden. But as you can see in Sweden, on a year-to-year basis, we are now starting to see some improvements here, and it's been stabilizing and now is coming down slightly. Whereas Finland, again, is the slight exception here, in which we continue to still see relatively high insolvencies, although on a positive, this was more significant in the first half of the year, and this increase has been slowing down a bit in the last few months. But we are still seeing this key difference. Where are we seeing the insolvencies? There's obviously a lot of change depending on the sector and the countries. I think some general trends that we do want to highlight is the fact that, again, energy intensive manufacturing to a large degree has struggled both with high costs, and there is a big interdependence on European demand there. And given that the European manufacturing sector has been quite weak, we have seen some of these sectors such as metals, paper, chemicals struggle a bit. In particular, for example, chemicals in Denmark, which energy prices are a lot higher than they are in northern parts of the Nordics. There's been a particular vulnerability. We have seen some increases in pharmaceuticals as well. I will say that very, very large number you're seeing there in Denmark is due to the fact that essentially there aren't that many insolvencies, which means you don't have to go see that bigger change before it sounds very, very bad, and this has literally gone from 1 to 10. So this will sound quite high, but in absolute numbers, this is actually not that as severe. Hospitality and recreation continue to be a sector that more or less across the board is struggling a bit, and one that we are worried about, with the somewhat exception of Denmark that is doing slightly better there, even if Danes have been slightly frugal with their increasing real wages. So on a European level, some of the bigger sector risk changes that we saw an improvement in construction in Spain. We are generally speaking slightly more bullish on Spain, and we now improved the construction sector to medium risk. In Poland, we saw some improvements, both the energy and ICT sector, which had been struggling more, and are now seeing a more benign in business environment and costs and ability to pass on increasing costs. We are more negative, and we have previously downgraded Romania, and we now downgrade a sector in it in addition to that, which is the retail sector, because we are still seeing quite low domestic demand in Romania. It's a country that we are more worried about in Central and Eastern Europe. I think I'll conclude here and leave some space for some questions. So if Pekka and Mona could join me again, we'll see if there's any questions we received throughout. Again, I think Mona can give the update, but you can either ask them here or write them in the chat or anything really.
Okay, thank you, Jonathan. And thank you also, Pekka, for sharing your insights. And then we're at the Q&A, and I already have a couple of questions, and you can still submit questions to us. So here's the first one. Everything seems quite grim. Are there any European economics doing better?
Yeah, so again, as I said, sort of the ones I just highlighted, we are seeing some improvements in Poland. There are more EU funds coming in as well, which means sort of the construction sector that had been weakening, we do expect to improve slightly. Again, as I shortly alluded to, we are more bullish on Spain. To be completely honest, Spain has been an outlier in Europe in the last few years, in the fact that they continues both really strong growth. To be completely honest, initially I think the story that most of us told was the fact that, well, tourism is doing well, so that must be it, right? It's just a tourism story. But there is actually an underlying of unemployment is really low from a Spanish perspective. Domestic demand is quite strong. Yes, its tourism sector is doing well, but so is the manufacturing sector, and to a large degree it comes down to Spain actually invested a lot of money in renewables, which means that when you have seen really increasing costs in Germany in particular, if you are a multinational European company and you produce both in Germany and in Spain, well, if your energy prices increase a lot more in Germany than they do in Spain, Spanish labor costs are also very competitive from a European perspective, well, then you also start moving some of your manufacturing down there. And so it is actually, to be completely honest, it's across the board that the Spanish economy continued to do really well. And it is a bit of an outlier in Europe from that perspective.
Thank you, Jonathan. Over to the next one. Any sectors that might be improving in the coming years?
Ooh, so that really depends on sort of where you are. If we look sort of further afield, we did downgrade somewhere like construction in the US. Again, you can see all these in our risk review if you want to go through all the changes. If we're more looking at Europe, again, there is a lot of potential within aerospace and defense in the next few years. I think that's kind of a given. Civil engineering continues to do relatively well. A sector that I think maybe is underestimated is actually the agri-food sector. Has been doing slightly better. Again, as I showed earlier, it's actually a sector where we have seen increase in turnover and activity, and I think it benefits essentially from the fact that Europeans, we are well perceived there. We have very high standards, which both means that we have some export opportunities. It also means we have a relatively restricted market, which means if you are a producer of anything, you actually usually can increase the prices if your costs increase, and there aren't necessarily as many alternatives because, well, other countries have to live up to the same requirements that you do. So that there actually is I'd say less vulnerability in the agri-food sector, which I suppose probably surprise some people, than some other sectors, in which, I mean, sadly, I'm sad to say that a lot of the energy intensive manufacturing in Europe, we do expect improvements in natural gas prices. given the fact that we are seeing increased capacity coming from both the US and Qatar. We're seeing improved grid infrastructure, improved ports. There will be some improvement, but a lot of our energy-intensive manufacturing just isn't competitive. So we are slightly less optimistic there, to be completely honest. Could I ask Pekka a question? Because something that I've been seeing is obviously, you know, we by nature focus a lot on sort of buyers, but I know that supplier risk is something that we are seeing to a larger degree. It's not just on that side. It's actually that, you know, supply chain resilience is not just an aggregate thing. It's not just something we talk about in macro. It's a real thing. Is that something we're seeing as well?
I think you're really touching the topic here, because supplier resilience or supplier risk management, or generally supply chain management, it's not an academic topic. It's a very micro topic. It's a really a factual item in the management teams of our clients. And I think the last 3-4 years have been so fundamental in changing the approach, how you manage your suppliers and your supply chains. You know, we've been educated with the idea of just in time, minimizing capital linked to your supply chain. Just make sure you are perfectly optimized so you don't spend one penny too many, and your inventory levels are as low as possible compared. So basically, you manufacture order against the order, and this has been a really kind of a challenging topic for companies to adjust. So equally, last week we had a session in Stockholm, and we were discussing about just in case, which is more of the norm today. So you kind of manage your inventories in a different way. You want to have an elevated level of semi goods to be, you know, meeting the request of your clients, but at the same time, it also goes for the funding side. So you really also need to maximize your resilience as a company. So it all kind of comes together, whether you are optimizing your liquidity attached to working capital. So what we see more and more is our banking partners coming to us asking for support, whether it's a supply chain finance solution, or we call it reverse factoring facility, and also same client looking for account receivable finance. So it's really kind of a hot topic. Then when it comes to your supplier risk management, we see a massive increase in interest to understand your tier 1 suppliers, but your tier 1 suppliers. So it's not just linked to who you acquire your materials, whether it's raw or semi-finished products, to finish your own product, but equally understanding your suppliers' risks, where they are getting their goods from, and what type of political risk you have, what type of sectorial risk you have, and who of your suppliers are paying their bills. So all these is kind of topics that have really emerged during the last, I would say 12-18 months. And yeah, you see more events around supply chain risk management. So that kind of also answers the question.
Perfect. No, it's an interest, and again, as you said, it's something that as an economist, it wasn't a topic a few years ago, and now suddenly it is something that suddenly has a big impact. We're realizing, which we kind of always knew, but just took it as a given.
Okay, thank you both. We don't have any more questions in the chat. Do any of you have any final reflection you want to share before we end the session?
I think personally, I do the presentation and usually sounds quite grim. And even if I'm in a good mood and I'm optimistic, it still sounds grim somehow. Yeah, I feel bad for my wife at times, but I try not to bring that attitude home. But what I will say is there is a lot of vulnerability out there, but there's obviously still also, there is some potential, there's some good risks as well. and that is something that we do want to highlight. There are some positive things. Inflation is coming down. Interest rates are coming down, most countries at least. So there is still some movement for some potential there. And I do think this larger reconfiguration of the world will lead to some potential. But the problem is we are a bit of in a transitional phase, and in transitional phase, usually there's some winners and some losers, and the losers will often end up in an insolvency, and someone has to pay something. I'm not sure, Pekka, if you have a.
No, I think you just summarized it really well. I think it's absolutely fair to expect that the world is not going to get any more, let's say, clear. Complexity will increase. This is a very fundamental shift in terms of global politics, and it's not showing any signs of relaxing or calming down. It will be probably seeing another couple of extremes when we figure out what is the level of uncertainty we'll just have to cope with. So with that said, I think it's absolutely clear that it's almost imperative to find partners you can trust, whether they are your traders, whether they are trading partners, whether they are funders, funding partners, etc., etc. This is what we see from our clients, new and existing, to really emphasizing the risk management. It's becoming absolutely critical pillar these days.
Perfect.
Thank you. Thanks. And we'll let that conclude the session for today. So thank you again, both to Jonathan and Pekka, for sharing your insights. And if you want more news from COFAS or more invitation to webinars like this, please just follow us on LinkedIn. And on behalf of COFAS Nordics, thank you for joining us today, and see you next time.
Mange tak.
Bye-bye.
Bye.